The economic surprise index. You see that blue line that's plunging, folks, in free fall? And that was before this morning's data, which of course hasn't helped. We're talking a Michigan sentiment number, misconsensus, sliding to a read of 66. Current conditions, the line in the middle, go all the way to the right, down 16.2% from a year ago. That's current conditions. The pace of this data is really what's amazing to me. In fact, take a look at this. The Michigan sentiment, this kind of pace has been associated with past recessions. In fact, all of the past recessions in recent years. Still, the vast majority of economists on Wall Street say there's not going to be a recession. My next guest, however, has been questioning that for a long time. I want to bring in now NatWest Markets U.S. head, Michelle Girard. Michelle, I don't want to put you on the spot.
Well, Charles, I've been calling for the recession for way too long. My problem has been we've been expecting it, we've been too early in our call. But our feeling was that the economy at some point would buckle under the weight of really a restrictive monetary policy, and we're seeing that starting to take hold. As you've talked about, the economic data have been surprising us on the weaker side, and I think we're seeing the pressure, particularly at the lower end of the consumer segment.
Right.
That there's a lot of pain out there.
Michelle, you are so humble. Do you know we have people who come on perma bears who are wrong for 15 years, and every now and then you get a crash and they say, I told you. And the market went up like 10,000% and it comes back like 40%, and they take victory laps and they go on TV, and TV they throw up the confetti. This man called the crash, in '87. All right, so that's why I love you. You're so humble.
Well, I appreciate that, but I got to call it. I got to own the call, if you will.
All right, that's cool. Now, here's what I'm worried about: the rate of change. Right? I feel like, and I've been saying it, and I've been saying, gradual and then suddenly. I mean, and it feels like almost every data points that's missed on a downside. Even more recently, the unemployment number. And this is what I'm concerned about. Why doesn't the Fed see this?
Well, I think you're right. In general, this idea that things just sort of glide slowly down and then, ease into recession, it's not usually how it works. It tends to come on much more quickly, where all of a sudden everything seems to sort of start to turn. I think the Fed is acknowledging this turn, if you will, in the tone of the data. The Fed chair, obviously, Powell, this week in his testimony, it was a lot more balanced, talking about the fact that the risk to the economy and inflation were balanced. You could see that it isn't just the inflation numbers that are driving the Fed's focus in terms of the timing of the rate cut, but it's also they're watchful now of the economic situation, and in a way that I think was not the case for many months earlier this year. And so I do think you're seeing an acknowledgement now that the Fed is taking into account the slowdown in economic activity, which of course does make them feel more confident that the inflation deceleration we've seen will indeed be sustained.
Yeah, I think he's reluctant to take an early victory lap, although toward the end of last year it felt like they did when they started saying, hey, we're going to cut. But this week he specifically, and he's been doing this, but put the onus on labor. How much, where's the point, what is the trigger on the jobs report, the unemployment number, or something that will finally convince the Fed to begin a rate cutting cycle?
Well, I don't think there's any one number. I think it's the cumulative, trends that we've seen, even with respect to the unemployment rate now moving up to 4.1%. Historically, when the unemployment rate has gone up by the average, 3-month average has gone up by a 0.5 percentage point, that's always signaled recession. You can put that into one of the other metrics that you use to signal recession. And I think the uptrend that we're seeing in unemployment and the unemployment rate continuing to move higher is going to be a concern. But I think the totality of the data, as you said, even just looking at the consumer sentiment numbers, these high frequency numbers that are coming in that are telling us more up-to-date information on the state of the economy, they're all signaling greater weakness. And of course, the Fed wants to act before the economy slips into recession, because policy does take a while to work.
Mm-hmm.
And don't forget, policy, we're only talking about the Fed lowering interest rates to take their foot off the brake. We're not actually talking about the Fed stimulating the economy or dropping rates below neutral to support the economy. We're just talking about getting back to a more neutral stance before the economy actually needs more monetary support.
Oh, all right, well, great stuff. Always appreciate our conversations, Michelle. Thank you so much. Have a great weekend.
Thanks, Charles. Have a great weekend.
All right.